During the 1920s, there was a big credit boom. So the amount of broad money and credit and total debt expanded a lot more quickly than the base money. It was leverage. And that all eventually hit ahead in 1929 and began to collapse. And even cutting interest rates to zero was insufficient to re-blow that bubble. So it actually started to fully collapse.
Lyn Alden delves into historical financial crises, drawing compelling comparisons between the 1929 Great Depression and the 2008 global economic recession and how they relate to the current economic landscape. Alden discusses the significant credit expansion during the 1920s, which mirrors the credit boom leading up to the 2008 crisis. She highlights the aftermath of these crises and how they shaped the trajectory of the global economy, and then relates these historical events to our current financial situation. Lyn further explores the 1940s, characterized by a public debt bubble and inflation. Comparing this era to the 2000s, Alden highlights a credit bubble, the 2008 crisis, and subsequent political polarization. The conversation shifts to the present, emphasizing the inflationary impact of broad money supply expansion and high sovereign-level debt. Central banks face challenges as traditional tools struggle to combat fiscal-driven inflation. Throughout the discussion, Lyn Alden also examines the complexities of central banks' abilities to tackle inflation in the face of mounting debt, hinting of an impending crisis about to occur. Here's her thesis. Also, make sure to hit the like button, subscribe, and drop your comments below.
And that lasted for a number of years until 1932, when they decided, okay, we basically have to print now. And so they expanded the monetary base, bank holiday, but the problem is you can't, if your monetary base is backed by gold and you just expand the monetary base, you're going to have a problem with your gold. So then they repriced gold. They made gold illegal to own in the land of the free. They recapitalized the banking system. But what that did is that kind of put America into like a economic malaise for a period of time where the crisis was over, but there was like this period of slow growth, private sector deleveraging. Some of the leverage was brought onto the public sector. And then you had a long period of rising populism. And of course, that was happening in Europe as well. That was happening in other countries. And that populism in multiple countries eventually contributed to World War II. And then we had kind of the second phase of this crisis, which was a gigantic public debt bubble across the developed world, large amounts of money printing. Unlike the Great Depression, that was more outright inflationary. And what they did in the 1940s in the US was they did yield curve control. So they said, okay, I mean, inflation's averaging 6% this decade. Inflation reached as high as 19% year over year in the United States, which was higher than even the peak of the 1970s. And yet they held interest rates roughly at zero, and they even pegged the long end of the curve at 2.5%. And so if you were holding bonds or cash, you just got completely killed on a real basis, even though you got paid back every dollar. And that's basically how they recapitalized themselves. If you were holding debt, you basically got defaulted on in real terms. And then we entered kind of that next era. And there's certain similarities today, which was during the 2000s decade, there was a gigantic credit bubble relative to the monetary base. That all blew up in 2008. They recapitalized the banking system by expanding the base money for the first time at that speed since the 1930s. That was a kind of a disinflationary crisis because you had a partial debt deleveraging, you had some money printing, but you didn't have a big increase in the broad money supply. And then, we had this decade-long period of rising populism. You had Tea Party, Occupy Wall Street. You had more and more political division. Just kind of an era of politics that was, very different than, kind of the middle of this past century, for example. And then, there's eventually some sort of catalyst. In this case, it was COVID. But when something like that hits a highly levered, highly polarized system, you get, bigger than normal responses to it. It looked a lot like wartime financing, a lot like the 1940s, which is why I began making that comparison so much. And so we've been in this era where now it's more inflationary. Now it's more the broad money supply itself is being inflated, or at least was until very recently. And the debt is now fully a lot of it's on the sovereign level. So you get to the point where if you have over 100% debt to GDP, interest rates become a more mixed tool for fighting inflation, because in addition to higher rates pushing down private sector credit growth, which is disinflationary, They also completely blow out the fiscal deficit, which tends to be more inflationary. And so the ability of central banks to fight inflation gets harder. I think a way of phrasing it is that most of the tools that central banks have are designed to accelerate or decelerate credit growth, and they don't really do anything about fiscal-driven inflation, and yet that's what we've had. And at a certain point, there's so much debt that their tools that affect credit growth can actually make the fiscal side worse. And so we that's why I think we're in the later stages of this overall kind of long-term debt cycle.
In this next clip, Lyn Alden discusses the concept of a fiscal spiral, where rising public debts as a percentage of the economy are no longer offset by declining interest rates. She reflects on past decades, highlighting the late 1980s and early 1990s when public awareness about the debt peaked. Alden notes a 30-year period of falling interest rates due to globalization and disinflation. However, as interest rates begin to rise, coupled with high debts and deficits, the world faces risks of a fiscal spiral. Higher tax rates may lead to larger deficits, fueling inflation and sustaining elevated interest rates. Alden suggests that bring a different economic environment, marked by ongoing inflation or recessionary conditions, as authorities grapple to control the situation.
Yeah, the fiscal spiral is when you have higher and higher public debts as a percentage of your economy, and importantly, they're no longer being offset by declining interest rates. And so if you look back over the past several decades, during the late 80s, early 90s, that was the prior period of the public zeitgeist was very focused on the debt because you had huge deficits, you had high interest rates, and so the interest expense relative to the size of the economy was very large. And so the infamous public debt clock, the national debt clock, went up in New York in the late 1980s. Ross Perot ran the most successful independent presidential campaign in the early 90s, based primarily on the debt and deficit. And so that was kind of the peak public awareness concern about the debt. But they ended up being 30 years early because we had the opening of China, the fall of the Soviet Union. And so we had 30 years of kind of disinflation, globalization, Western capital coming together with Eastern labor and resources, connecting cheap Russian gas to Europe, a cheap manufacturing out of Asia for the whole world. And so we had this kind of 30-year period then of falling interest rates, disinflation, and so that helped offset any sort of ongoing public debt to GDP issues we've had. But the problem is now is that once you hit zero and you start to bounce off zero and go sideways to up in terms of interest rates, while you still have very high public debts and deficits, we're kind of back to that early 90s, late 80s period. But this time we've squeezed more juice out of the orange. So there's less ability to kind of have another wave of doing that, kind of pushing it away. And so I think for the first time in a long time, we actually have, risks of a fiscal spiral that higher interest rates can feed to large deficits, which can then feed to more inflation, which can then keep those interest rates elevated and basically cause ongoing sustained inflation, or to the extent that they're able to get inflation under control for brief periods of time, those are likely to be kind of recessionary conditions. And then if you try to stimulate out of the recession, inflation is likely to come back. So I think the 2020s environment is going to be quite different in that regard than the 2010s environment.
Let's recap. Lyn Alden has shed light on the intricate patterns of credit expansion, political dynamics, and the challenges posed by rising public debts. From the 1920s, credit boom leading to the Great Depression, to the 2008 global recession, and now, Alden drew compelling parallels, offering a unique perspective on our current fiscal landscape. As we wrap up this discussion, it's crucial to recognize the significance of these historical events in shaping today's economic policies and market trends. The emergence of a potential fiscal spiral, where higher tax rates might fuel larger deficits and inflation, poses a complex challenge for policymakers. We hope this deep dive into the past and present has provided you with valuable insights into the complex world of finance.